The disparities in wealth between the various entities are crystal evident, and the political repercussions of this are huge. There will be more friction between the left and the right, and this has been linked to the new monetary and credit systems. We have 0% interest rates, non traditional monetary policy, and questionable effectiveness of quantitative easing. We have entered a new era in which government borrowing and spending will be more commonplace than the traditional monetary financing provided by the capital markets and central banks. The value of money will be significantly altered as a result of it. This is a turning point in history. On the other hand, we know you're curious on what does these recent events means for us. So, for today's video here at Data Dash, we will be delving deeper into Ray Dalio's final warning for all of us. But before we go ahead, make sure to hit the like, subscribe, and bell button if you want to keep seeing more of our content as you move forward. But besides that, let's get started. To start off, the character of capital flows between the strong and the weak will shift as a result. We believe it will have significant political and economic ramifications that will become clear over the following 2 years. When we consider the rise and fall of reserve currencies over the past 500 years, we realize that this is a pivotal time in the evolution of the global monetary system. Extremely reminiscent of World War I just before World War II, there are significant differences in wealth, income, and access to resources the same moment. Growth of debt and monetization are necessary components of monetary policy and debt policies when the interest rate is zero. The country's economic growth and military might are giving it an edge over its rivals. Wars break out between nations over resources and control that exists in the United States and many other countries or between countries, including the trade war, technology war, geopolitical war, and capital war between the United States world order and the emergence of China. Then there's war to consider. Because this has happened so many times before in history, we fear the future will be even more difficult for us. This is a watershed moment that will determine the nature of our relationships both within and between nations. Because it may be more interesting to others, we'd want to highlight the portfolio to help everyone. There is a period of extreme peril and uncertainty. Therefore, we think there are 3 terms to keep in mind: differentiation, diversification, and liquidity. We need to diversify our investor base beyond just the more common places. Therefore, using a variety of approaches can lessen danger while increasing potential gain. Thus, this necessitates a spread of currencies, including reserve currencies. Portfolios should begin with broad exposure to many currencies, asset classes, and countries. With sufficient liquid resources, you may adapt quickly to new situations and set yourself apart. In such a setting, there are 2 possible societies that can maintain peace and success. That sort of specialization is crucial to the success of the company. In biology, this is reflected in the financial statements. The resulting disparity in cost is readily apparent. Second, being physically close to the people who control the money supply. Not only does much of the developing world lack access to such aid, but the region also struggles to maintain political and social stability. The market reflected the differences in its behavior that were visible in countries that were successfully containing the spread of the virus and working together. They will make money if they can identify something that generates a positive number. The market's current behavior is a direct result of the ensuing money flows and resulting leverage. Because they are creating so much debt and so much cash to pay for it, bond and cash holdings should be avoided. This thus alters the character of monetary transaction. It's also altering the relative value of those flows to China's economy and market. In our opinion, it is acting reasonably, but you should not rely on outdated multiples as indicators of the bounds of what can be afforded. Allow us to skip ahead quickly to the financial aspects of the cycle. Debt and credit provide purchasing power, which is at first stimulating but ultimately depressing because of the need to make repayments. So, whenever an economy starts to falter, a shot of credit is used to give it a boost. Someone's assets equal that mountain of debt. Claims on actual products and services are what make up a company's financial assets. We typically use the definition of those financial assets, but selling those assets is their only real use. A fight breaks out, a victor emerges, and the playing field is redrawn. People didn't give it any credence since they equated it to worthless checks in a checkbook rather than gold. Because of that gold and that mechanism, we were able to make purchases. People are more willing to lend to us since we have access to the reserve currency. The drop in real rates has put us in a similar scenario. Hard currency is in short supply, yet everyone could use more of it, since it is possible to print money and create credit. Both the government and the central bank issue large quantities of both. There's a little point in keeping this money because of the inflation rate, taxes, and other expenses. If you consider bonds, you'll see that they offer very little incentive. This is all the cycle you need. So now we have a supply demand problem since we know we'll need a lot more money and a lot more debt in the future. The dynamic occurs because printing more money requires more money, which in turn necessitates raising taxes. We're free to elaborate further on the fascinating goings on in that dynamic. If you don't put restrictions on the flow of capital, the money will flow wherever it can get the best return, which is usually everything else. In 71, we found out the hard way that it makes similar stocks rise. As a result, it affects the workings of the stocks in every way imaginable. The value of a dollar is rapidly decreasing. To begin, there are essentially two distinct inflation rates. Supply and demand drive price increases. When there is a large amount of demand but not enough supply, prices rise and inflation occurs. And then there's monetary inflation, which happens when there's too much debt out there, leading to the creation of additional money and the burdening of bondholders with more interest payments. Bonds are merely a promise to receive money that the central bank can produce. Bondholders invest this money in the aforementioned ventures. From there, one need only follow the money to determine which parties actually receive the promised funds and what they do with them. So if you make a switch, whose turn is it to pay now? We're going to raise taxes, which means the other things will raise taxes, and so on and so forth. It follows that supply and demand based inflation measures are not the most relevant ones. They're the type to act in such a way. You can put down as much as you'd like because there isn't enough money. Simply said, monetary inflation follows the breakage of the relationship. When you've done the other things, you'll know you have that too. This is the risk then. Supposing there are two possibilities, we would state that there are two hazards. We invested so much money, so naturally there will be a ton of interest. Because there is so much money floating about, the value of just about every investment option has increased. However, there is a large sum of money in addition, which will affect the total sum of cash currently in circulation. Now that's in ca- Now that it's in cash, it can be discarded with the rest of the garbage. We would say that because the real return on investment will be negative. The actual risk right now is that inflation will accelerate. Much of it is in cash, and although more money will be issued, the rate of inflation will rise. Inflation in housing costs, inflation in general, and inflation in many other areas are all on the horizon, as is the possibility of inflation in the cost of labor. Even if wage inflation and the like do emerge in today's increasingly digital society, they will take on a unique form. The capacity constraint does not apply to the production of those products whose supply is digitalized. But the main monetary inflation is the question where we put our wealth. Because what happens to the markets is that when you move to those other things, let's say stocks, real estate, and other things, they're going out of that. Future projected returns decrease and approach the interest rate as bond prices rise. You now have the equivalent of the current interest rates. Prices vary by country but tend to decrease. The whole system collapses if people lose their motivation to buy those products, which could generate problems and make it impossible to tighten monetary policy. Negative real returns in stocks and other assets are possible if the central bank prints enough money to keep interest rates high, as was the case in the 1970s. This pattern of the nominal and rising has occurred many times. We are merely describing how it works, but there will be certain things that will remain broken for a very long time, and then there will be some things that will be radically altered. On the other hand, that concludes our video for today. We hope you found Ray Dalio's insights into the state of the economy enlightening and thought provoking. Now, we want to hear from you. Do you agree with Dalio's warning? Or do you have a different perspective on the future of the economy? Share your thoughts in the comments below. Once again, this is Data Dash. Thanks for watching. And if you enjoyed watching this video, then go ahead and hit the like, subscribe, and bell button for more of our crypto updates for you. Thanks again for watching,